Hello everyone, thank you so much for joining me for another commercial mortgage video. Today we're going to be discussing how to calculate mortgage payments, as well as a few awesome tools that you can use to calculate mortgage payments. Let's get into it. All right, so first things first, let's just talk about the type of loans that you're typically going to have to calculate a payment for. Well, first off is your interest only loan. So that's like a typical hard money loan, maybe like a 12-month interest only, or maybe like a 36-month interest only bridge loan. And then you also have your traditional fully amortized note, typically around 30 years. Now, the formula for doing interest only looks like this. You take your interest rate, you multiply it by your loan balance, and you divide it by 12 months. If you do that equation, that's going to get you your monthly payment. Now let's look at an example. All right, so let's say you get a loan term and it says the interest rate's 9.99% and you're at a $350,000 loan amount. Now, the equation's very simple from this point. All you do is take that interest rate and you multiply it by the loan amount. Now, as you can see, we don't multiply it by 9.99%. You always got to carry that decimal to cover the percentage. So what you're going to do is you're going to do $350,000 multiplied by 0.0999, and that's 9.99%. Then you're going to divide it by your 12 months, and poof, you get your interest only payment, which is $2,913 in this case. And all this is just interest only. So this is only for an interest only loan. So if a lender says, hey, we're going to give you a 12-month interest only loan, this is what you're going to do to calculate that. Now, when it comes to your fully amortized loan, this is what the formula looks like. As you can see, this is a pretty complex formula. Nobody in the right mind is going to do this formula at their desk. It's just simply too complicated to manually calculate on your own. So what most people do to calculate the fully amortized payment is they use an amortization calculator on the internet. So what we're going to do is we're just going to look at a couple of those tools. And actually what I've done to make things a little bit easier for you is I've gone ahead and created a couple QR codes to calculate both interest only and fully amortized. There's a website called bankrate.com, and that's where a majority of people actually go when they want to calculate with the mortgage payment. So if you want to just scan the QR code, this will send you straight to Bankrate. And just so you know, I'm not getting paid by Bankrate. They're just the best calculator on the market. Very easy to use, and I'm going to walk you through one of those use cases right now. But if you just scan the QR code on interest only, it'll take you straight to their calculator. If you do the amortized one, it'll take you straight to their calculator. Now let's take a look at a quick example using the fully amortized calculator on Bankrate. All right, so as you can see here, we are at the amortization schedule calculator at bankrate.com. It's a very easy tool to use, and it has a bunch of awesome metrics that you can use to explain the loan to your borrower. But let's just use the same example that we had before. So let's say it's a $350,000 loan amount. The term's 30 years in this case. That's typically what you're going to see on a fully amortized loan. And let's say we are at 9.99%. Now, assuming we start in December, which is this month that we're in right now, this is what you're going to get for the monthly payment. So that's your interest and principal payment, and it's going to be the same for 30 years. That's what fully amortized is. It means the interest is always built in with the principal on your payments, and the payment doesn't change for the life of the loan. So it's really neat. You can see the total amount of interest that's going to be paid on the loan is right here, $754,000. The total cost of the loan is 1.1. And it's really neat. You know, you can even walk the borrower through, hey, in 2033, this is where you're going to be at on your loan balance. Your interest paid is going to be 336,000, principal paid 31. So you can really show them like the cost benefit to using a fully amortized loan. You can also do some pretty neat things. You can change the amortization to 20 years. I have a product that I sell to 10-year interest only. And then after that, it amortizes over the remainder of the 30 years. So sometimes I'd have to calculate a 20-year amortization in this case. And there's a couple other options here too. So anyways, this is how most people calculate the amortized payment. They don't do the calculation at their computer. They normally go to a calculator online, and Bankrate seems to have the best one out there. I want to thank you so much for joining me for another Mortgage Accelerator video. If you haven't already done so, hit the like button, send me a comment on what you want to learn about next, and of course, subscribe and get the notification bell. Thank you so much. We'll see you in the next vid.